In this video, I'm going to teach you how to earn $100,000 a year completely tax-free in your retirement. Yes, it's true. You can bring in $100,000 a year in Canada completely tax-free in retirement. Yeah, us early retirees, we have it sweet. Those people who have nice, large portfolios that are paying great, healthy returns through dividends are not paying a ton of tax. Let's get into it. If you haven't heard about how to get $100,000 a year tax-free as a couple, smash that like button, jump in the comments. I want to hear about it. Let's have a conversation about how early retirees in Canada are #blessed. If you're from Scarborough, you'd say blessed found. Blessed. Dividends, that's the key word. You heard me say dividend. What is a dividend? Dividend is when a company has a profit and they pay that profit out to the shareholders in the form of a cash distribution. This is a dividend. So dividend payments, they're paid on a quarterly basis or a monthly basis, sometimes semi-annually, usually quarterly basis. You can buy stock portfolios and own shares in companies that just pay dividends. Most of the large blue chip companies here in Canada or in the United States pay dividends. Here's the catch though. It's got to be a Canadian eligible dividend. If you look at the tax code, guys, and you take a read in, what you'll find is that around $51,000 a year per person. So if you're a couple, you can each bring in about $51,000 a year in dividend income if you have income from no other source. Here's how it works. Dividends that are Canadian eligible get a gross up tax credit here in Canada because the corporation has already paid tax on those dividends. So when a company pays out a 5% dividend, let's just say on a 5% yield, 5% annually on the share price. Let's say you had $100,000 in a major big five bank here in Canada. All of them pay 3-4% dividends all day long. Bank of Montreal, TD, RBC. Lots of companies pay dividends, but I'm using those as an example just so you can follow with me. They pay tax on those earnings and then they pay you 4%. Canadian government gives you about a 38%, and check my facts on this, it may have changed a little bit. I'm not a CPA or an accountant. I did study accounting in school, but I'm not a licensed CPA and I do not pretend to give advice. This is a fact. I can link in the description to some articles, the Financial Times, and places where you can verify all of this information, and it is true. With the gross up tax credit, you get this dividend in that comes in, and the government of Canada says if you're investing in Canadian companies and collecting Canadian eligible dividends, then you get a gross up tax credit of about 38% back. At about $50,000 in dividend income, your tax rate's around 38% on average, and so the two clear each other and you pay net no tax. As a couple, that's $50,000 each, no tax. And I'm going to talk about some other strategies like tax-free savings accounts. Here in Canada, way understated and under talked about. I want to do a whole video just on the TFSA and how the tax-free savings account works. You want to use your tax-free savings account to buy interest-bearing debt ideally because it's taxed at the highest rate, not Canadian eligible dividends. But the beautiful thing is this, you can contribute to it each and every year. Right now it's around $60,000 you can have in your TFSA. And if you had invested that over the last 10 years since they opened the TFSA program, many people at a 7 or 8% growth rate have well into the 6 figures in their TFSAs. Tax-free savings accounts can grow and earn interest income at say 10 or 20%. You could put your TFSA and lend it out as a mortgage, for instance, and get 20 or 30% rates of return secured against real estate. Or you could just buy equities and hold debt-bearing instruments like bonds, for instance. So lots of options. You can get your TFSA over the next 20 years or run a model. If they allow the TFSA to continue as it currently is, and likely they will, and likely what we'll see is they'll be grandfathering on the tax-free savings account, such that what you'll find is that any growth you've had up until now, they'll allow you to keep even if they change the program. This is what they did back in the 80s with a lot of those huge universal life and whole life insurance policies that they capped off. So you could have over a 25-year period, if you're planning to retire in 25 years, max out your tax-free savings account each year and then invest that and have it grow at 7 or 8% in stocks or interest-bearing debt. And over time, you'll see it'll double every 6 or 7 years. And by the time you're ready for retirement, you'll have $1 million in your tax-free savings account. Go invest that at say 7%. There's $70,000 a year tax-free. Oh, and doesn't impact your tax bill at all. So you can collect another $50,000 in open, non-registered accounts, as in not an RSP or TFSA, and an open margin account. Collect another $51,000. Probably by the time you retire, it'll be $60,000 or $70,000 in tax-free Canadian eligible dividends. If you're buying Canadian eligible companies, there's a ton of them that I love, and there's funds you can buy directly that just buy dividend play stocks. So you can be diversified on hundreds of different companies that are all paying dividends and averaging you a nice 5 or 6% return. You can invest in things like utility type companies. They're great because they have strong cash flow and they pay great healthy dividends. Not as much of an appreciation upside play for capital gains, but you do get that steady, consistent cash flow that we crave when we're looking passive income in our retirement. So imagine if you have $70,000 a year every year from your tax-free savings account that's off limits from the government touching. There's no tax from that on any gains in your tax-free savings account. Plus you had $50,000 or $55,000 $60,000 in dividend income by the time you get there. I'm sure with inflation, it'll hedge out. Right now, it's around $51,000 in eligible dividend income. And then imagine you had a partner who also had tax-free savings account, another $70,000 and another $50,000 in Canadian eligible dividends. You would have, what is it, 70 and 70 is 140, and then another 100 is $240,000 a year, completely tax-free. The Canadian early retiree, people keep jumping in the comments and saying, Mike, you're not thinking about taxes. What about tax? You could never retire because of tax. And it's like, whoa, hold on a sec. Go look at the Canadian tax system, and the US one's pretty good too. It's actually better in a lot of ways. They have the 1031 exchange, and say the first $12,000 you earn in Canada is tax-free. So a couple can bring an active income of $25,000 a year household, $12,000 each, and pay no tax, zero employment income, any kind of income. And then the next tax bracket is around 20.5%, I believe. So you're gonna pay 20% tax on any income you earn above that if it's not Canadian eligible dividends. And if you had no other income of any kind and you just collect a dividend income, again, $50,000 tax-free. Amazing. The tax-free savings account, another amazing vehicle at our disposal. Real estate, another great vehicle at our disposal. We can use a lot of write-offs to keep the income way down. You can also use corps, you could imagine, to house a lot of your income and collect that dividend income personally, take that $50,000 tax-free personally, and then run no other income into your personal name, right? So there's a lot of strategies you can think about, but the tax burden is not near as bad as you think about if you do some tax planning. Your early retirement could be tax-free. So I just want to throw this quick video out there and say, did you know about that? Jump in the comments, smash the like button. So that's a beautiful thing. I'll see you guys in the comments, and hopefully you guys enjoy this quick little video, just shooting it out there to get the idea around that Canada is a beautiful place, and if you're an early retiree or someone who has a good amount of wealth, there are ways you can structure things with trusts and corporations to pay no tax, and without any of that, just collect dividend income, Canadian eligible dividend income. There you go. There's your retirement strategy. Tip of the day with Mike Rosehart. Secret to unlocking a wealthier you. You guys already know it. Spend less, earn more, and maximize your returns. Those are the three levers. That's all you can play with to become a wealthier you. So I'm going to give you strategies to crank all three levers up to the max. See you guys in the next episode. Mike Rosehart, out.